Families provide not just basic needs for children, but also emotional needs. A loved one can be a source of strength during hard times. In addition to providing emotional and physical support and comfort, your family members can also prove to be instrumental in providing you financial benefits. When it comes to your income taxes, certain money hits can be associated to specific family members in a way that gets you tax breaks. In tax saving, different members of your family can help you, be it your parents, your wife, or your children. And in this video, I will be breaking down things for you step by step and tell you how exactly you will be able to save your taxes with proper examples. Watch this video till the very end, as this video will benefit you for the rest of your life. Also, since I'm all about giving, let me tell you that there is a full-fledged course on our app for tax planning, so you can go on our app and learn about this life skill. You can simply download our app, Freedom app, from the Play Store and definitely add value to your life. So guys, without any further delay, let's start with today's video. We'll start the video by how your parents can help you in saving taxes. Your elderly parents can save you from paying a substantial amount in taxes each year. There are different provisions using which you can take advantage of things. Number one, investing money in your parents' name. People aged 60 or older can claim up to rupees 50,000 as tax-free interest earnings from bank FD savings account, post office schemes or more. For everyone else, this limit is much lower at just rupees 10,000 a year. Thus, parking your excess funds in your senior citizens' parents' account can reduce your tax liabilities considerably. The tax rate is also lower for senior citizen taxpayers, enabling them to pay limited taxes even if their income crosses this tax-free lab. For those aged 80 years and above, the tax-free yearly income slab is rupees 5 lakhs, whereas for people under 60 years, this is just rupees 2.5 lakhs. Number 2. Claim HRA by paying rent to parent. Salaried individuals can reside at their parents' house and pay rent to them to claim HRA benefits. In such a case, your parents can claim a 30% tax deduction on this annual rent receivable for maintenance and repairs as per section 24. For example, your annual rent is rupees 2.4 lakh. Your taxable rent is equal to 2.4 lakh minus 30% of 2.4 lakh, which is equal to 1,68,000. HRA benefit will be equal to the least of these three provisions: 40 to 50% of basic salary, actual HRA offered by your employer, actual rent paid after subtracting 10% basic salary. Suppose actual HRA offered is rupees 18,000, actual rent is 20,000 and basic salary is 22,000. In such an event, HRA benefit would be the least of these. 50% of 22,000 equals to rupees 11,000. Actual HRA equals to 18,000. Actual rent minus 10% basic equals to 17,800. Therefore, HRA tax benefit in this case is rupees 11,000 a year, which you can claim. Number 3. Tax deduction on health insurance premiums. If you're paying for a health insurance policy for your senior citizen parents, you can claim a tax discount of rupees 50,000 per year. If your parents are younger than 60 years, the maximum permissible exemption is rupees 25,000 a year. Both of these come under section 80D. So these are some of the ways in which your parents can help you in saving tax. Now let's talk about how your spouses can help you in saving tax. Number 1. Double tax savings on joint home loans. If you and your partner have opted for a joint home loan, each of the co-borrowers is eligible for a substantial deduction under Section 80C and Section 24. Section 80C's limit is up to rupees 1.5 lakhs and it is based on actual principal repayment. Under Section 80C, husband plus wife equals to rupees 1.5 lakh plus rupees 1.5 lakh equals to 3 lakhs. Total exemption on yearly home loan principal repayment. Under Section 24, husband plus wife equals to 2 lakh plus 2 lakh, which is equal to 4 lakh total tax discount available on yearly interest payment. Section 24 offers up to rupees 2 lakh per borrower as a benefit on interest payments. Thus, joint home loans with your spouse can double your savings. Keep in mind that such a provision is only applicable in case of a self-occupied residences. Number 2. Tax saving on financing your spouse's education with a loan. Section 80E benefits are also applicable if you avail education loan to fund your spouse's higher studies. Benefits are calculated based on the amount of interest serviced in a given fiscal year. For instance, if the interest on an education loan for a particular year is rupees 70,000 and your taxable income is rupees 5 lakhs, after deductions under section 80E, new taxable income is equal to 5 lakhs minus rupees 70,000, which is equal to 4.3 lakhs. Number 3. Gifting your spouse money to reduce income tax liabilities. Suppose you extend a particular sum of funds as a credit to your spouse. You charge interest on this amount at 5% per annum. Now, you can ask your partner to invest this loan principal into one of the many investment schemes where the return rate is higher than a 5% a year, say 9%. In such a way, you bear taxes on your interest earnings from this loan to your spouse. Nevertheless, it is still a profitable move since your partner earns higher returns from a different scheme. Keep in mind that your partner would not need to bear taxes on capital earnings if the same does not exceed rupees 1 lakh per year. Assume loan principal is equivalent to 50,000, interest rate is 5% and the tenure is 1 year. As a lender, one partner would earn interest of rupees 2,500 on which he would need to bear taxes. Now consider that the other partner invests in the following scheme. Interest earnings from this scheme would be rupees 4,500. This interest is tax-free, enabling the partners to pocket it without any liabilities. This is not all. Your children can also help you in saving taxes. Let's see how. Number 1. Opening a bank account for your children. You can avail up to rupees 1,500 as a tax discount on the interest your child acquires from his or her savings account balance as per section 1032. This rupees 1,500 benefit and is available on any income or earning in your kid's name and not on bank account interest alone. Keep in mind that this is the upper limit for one child. Thus, if you have 3 children with bank accounts, the combined tax saving would be 1,500 into 3, which becomes 4,500. Section 80E has a provision for parents to save taxes based on the yearly interest payment on their child's education loan. For instance, if your taxable income is rupees 4 lakhs, after considering all applicable deductions and the interest payment for your child's education loan amounts to rupees 1 lakh in that year. Your actual taxable income then is equal to 4 lakh minus rupees 1 lakh, which is equivalent to 3 lakhs. Number 3. Dependent child with a serious disease or disability. According to section 80 DDB, you can claim a deduction of rupees 40,000 based on expenses related to treating severe diseases. If your kid suffers from disabilities, you are eligible for a maximum deduction of up to rupees 75,000 a year on income taxes. For example, if a person's taxable income after all other deductions is rupees 5 lakhs, his actual taxable income would be reduced to the following amounts in case of disease or disability of the children. In cases of diseases, taxable income is equivalent to 5 lakhs minus 40,000, which becomes 4 lakhs 60,000. Keep in mind that this provision can be extended up to 8 years from the year when interest payment on education loan begins. Number 4. Investing in the names of independent children. Kids over 18 years are considered independent of their parents, even though most such individuals do not begin earning at such an early age. At such a time, parents can give their child money to invest in tax-free investment schemes. Returns from such instruments are considered as income for your kid and not your own. For instance, a father gives his 18-year-old son rupees 50,000 to invest in mutual funds. At the end of the year, he claims rupees 55,000 from this instrument. If you acquired an interest of rupees 5,000, you would have to bear taxes on the same. However, since this income is in your adult son name, no taxes are applicable. Number 5. Acquire health insurance for children. If you are currently bearing health insurance premium for a medical insurance plan covering your children, you are eligible for tax benefits of up to rupees 1.5 lakhs under section 80C. Moreover, under section 10, you can claim an additional rupees 9600 as a rebate on your taxable income if you have 2 or more children. Number 6. Tax saving from tuition fee. You can also take advantage of tax saving opportunities on your children's tuition fee under section 80C if you are still to hit the rupees 1.5 lakh upper limit on this provision. Besides this, you can claim rupees 300 as education allowance each month for up to 2 children, that is 300 into 12 into 2, which is equivalent to 7200. Lastly, tax benefit on hostel fees amounts to rupees 100 per child per month for a maximum of 2 children. That becomes 100 into 12 into 2, which is equivalent to 2400. These last are provisions under section 10. Number 7. Saving taxes by investing in mutual funds, PPF and ULIPs in your children's name. If you invest on your child's behalf in PPF, mutual funds and other instruments, you are eligible to club the returns from these with your tax benefits under section 80C. If the income exceeds the rupees 1.5 lakh rebate, the additional earnings would be taxed normally. Consider an example where Mr. Verma has a taxable income of rupees 1 lakh. His underage son has income from 2 distinct instruments, namely PPF and mutual fund. The former earns him rupees 5,000 while the mutual fund nets returns of rupees 20,000. The PPF earning is tax-free while the mutual fund earnings will be deducted from taxable income as per section 80C. Therefore, actual taxable income is equivalent to 1 lakh minus 20,000, which is equal to 80,000. So guys, these were some of the ways in which your family can come in handy for you to save taxes. As I mentioned in the beginning of the video, if you want to learn more about saving of taxes or about personal finance, download Freedom app from the Play Store and I make sure that you will benefit a lot from this. This is Abhinav Sehgal signing off. I will see you in the next video. If you like this video, share it with your friends and family on WhatsApp and other social media platforms. Until the next video, guys, stay happy, stay safe.